I am delighted to have here with me today Clive Pacey from CPCM Finance, who is an expert on credit insurance and finance. Okay, Clive, let's cut to the chase.
Okay.
What's credit insurance and how would it work in a Carillion situation, for example, where you discover that the contractor's not good for credit?
Okay, there's two things. I mean, credit insurance insures your debts. Okay, that's a simple fundamental aspect of it. It insures probably up to about 90% of your debtor. Right? The one thing that is crucial is that most credit insurers will not offer credit insurance just for one debtor.
Okay.
You have to insure the whole of your ledger. It actually works out cheaper to do that than to do it for one debtor. And there's obvious reasons for that, of course, because it spreads the risk and so on and so forth. And they're always a little bit nervous about taking on one debtor if you believe you should take on one debtor. But that's the way it works. You pay a premium each year. And what you get for that is cover up to about 89% of the debt, and also you will receive information or feedback information from the credit insurers who'll be very much in touch with what's going on with that debtor as well.
Okay, so let's take the Carillion situation in my credit referencing video where we discovered that they were habitually late payers. Is that something that a credit insurer would take into consideration when agreeing to grant credit?
Late payment isn't so much an issue, but if it becomes protracted, then or they're paying way beyond the agreed contracts, then it will become an issue. The key thing with Carillion was that they often bullied their suppliers into 120-day, 180-day terms and so on. And if they pay to those 120-day terms, they're not late payers. They're just actually paying to terms.
Okay.
The main thing that credit insurers will look at is their balance sheets and their profitability and the sector they're in as well. That comes first, but payment records will come into it to some extent.
That's interesting, because that's something in my credit referencing video that we tried to avoid looking at in terms of giving credit, because it can be misleading. Most certainly, as we discovered with Carillion, because Carillion at first sight had good financials.
They were a little bit stretched.
Yeah.
To be fair. They were very highly geared.
Okay.
Yeah.
And perhaps for that reason, because the credit insurance weren't looking at the payment trends, that might be the reason why they would have given credit in what is
credit insurers
high risk market construction.
Credit insurers did get covered to Carillion, but I'm not sure how much cover they gave.
Okay.
I mean, when Carillion went down, they owed $2 billion. I think it was about $2 billion to unsecured creditors.
Okay.
Out of that, the credit insurers only paid out $30 million.
30 million.
Yeah, a very small proportion. Now, whether that's down to the fact that the suppliers couldn't get credit insurance, or whether down to the fact that suppliers weren't seeking credit insurance, it's probably a combination of the two. But we don't really know. We don't know the full detail on that.
Okay, so would you recommend credit insurance in this type of situation?
I most certainly would. I think I would recommend credit insurance if you've got in certain sectors. If you're dealing with certain types of clients.
And what sectors would you consider?
Construction, although it won't be cheap. Construction's quite important because in construction, most construction clients don't have a wide spread of debtors. They might be only dealing with a handful at a time, or have high concentration with certain debtors. And if any of those go wrong, it can put the future business at stake. Retail, I'd certainly suggest it because retail is obviously a very tricky area at the moment with a number of companies going under. And if credit insurers withdraw cover on a retail company, you can almost guarantee that retail company won't survive that. So it becomes a bit of a chicken and egg. You know? Credit insurers don't like the accounts, as with Maplin. They withdraw the cover, and then Maplin can't get the stock in because the suppliers won't supply.
That's interesting. So even though you may get credit insurance to begin with, they can withdraw cover.
That's right.
And how? In what situation would they withdraw cover?
Negative information. Usually filed accounts. Maybe a really bad payment history, but I'd say the filed accounts are probably more the driver than anything else.
That's an interesting lesson. So, an interesting lesson from here is, don't think because you've got credit insurance you're going to be covered for the lifetime of the account.
No, you will. They will try and maintain the cover as much as they can. They won't just withdraw it, and they'll maintain it for what you've already got outstanding. So if you've got 100,000 cover and you've got 100,000 pounds worth of invoice outstanding, they're covered. Right? Okay. They can't retrospectively withdraw it. If they start reducing it or withdrawing it, then it's usually quite a signal that they really believe that company's in trouble.
Okay.
So it acts as a bit of an insurance in itself, you know.
Yeah.
They're really telling you not to supply above a certain level or not at all.
Okay.
You know.
Okay.
But yeah, some people will question credit insurance and they go into credit insurance thinking that everything will be covered regardless, you know, regardless of their transactions. It doesn't work that way.
Okay. So, as with any insurance, would you suggest that you be careful when you make a claim?
You can only claim when the company goes bust.
Okay.
You can only do it then. What I would suggest is that when you get your policy, you go through experienced broker, and I know experienced broker very well,
Yeah.
and to find the best possible option, because there are about 12 providers out there at any one time, and they do vary what they will cover as well.
Okay, excellent. And that's something that you could help customers with
definitely. Yeah.
by putting them in touch with a recommended broker.
Yeah.
Very interesting, and a nice way to end off this subject on credit insurance.
Right.
So there's a great lesson to learn there. Credit insurance is there to insure the risk of the account customer, in the example of Carillion, going bust. Very useful, but remember, you're not guaranteed cover and they can withdraw the same. Is that a fair comment?
Absolutely.
Okay, excellent. Thank you very much, Clive, for coming in today. Some fantastic advice there on credit insurance. Very informative and an education. For any of you that are interested in the products and services that Clive described in this video, please do give Master Collections a call on the telephone number that will appear at the end of this video.